Yes, so coming to the plotting aspect, this is one of the most litigative aspect that we can expect in the last 2-3 years, because most of the advanced authority rulings have been prevalent in the WhatsApp groups and also in the public domains, and a lot of analysis has already been placed on the authority rulings. So specifically, if you ask me in terms of the land definition itself, uh, the land which, as per the Immovable Property Act or as per the various judicial legal interpretations, anything which is attached permanently to the earth comes to the perspective of land. So once the land is developed and once the infrastructural facilities, the amenities are added to that particular land, and once the plotting perspective comes into picture, the argument of the department has been that this particular plotted land, which is the developed portion of the land, whether it is enhanced value, the value which is barren land versus the plotted land, obviously there will be some 200% variation in the margin or in the price at which the builders or the developers are selling it. Once there is a specific impact in terms of the increased value, whether it is going to have the GST component on it or not is this question. Various authority rulings in terms of the developed plot, normally the developers are doing it in four specific instances. In terms of doing it on their own, the developer gets the land and does the development on its own, or he hires a third party contractor or a subcontractor to get it done, or the landowner as well as the developer form a JDA and then divide and share the plotted developed land into revenue sharing agreement or an area sharing agreement as well. So when it comes to the specific aspects of whether the land itself or the plotting itself is taxable or not, there are instances of Supreme Court rulings as well on the screen which mention that land which is permanently attached to the earth or the amenities arising or the benefits arising out of land should not be considered as part of the taxation perspective or GST perspective. But when it comes to the specific aspects of the AR rulings, specifically, the idea of the department has been to charge the GST aspect on the increased valuation, on the increased value. Say suppose that land for barren land or land in acres is coming up to a specification in terms of 1 crore rupee. Then if you divide it by 4,000 square yards or whatever land component, and if the developed land is coming up to 2,800 square yards itself, then in terms of the 2,800 square yards, if the per square yard is increased to some 15,000 or odd, then the entire value will go for a toss. But why there is a change in the valuation that happens through the development is that the amenities and the infrastructure which are getting developed by the developer will add to it, whether he does it on his own or through third party or the developer or the JDA program or a partnership firm or a hybrid model. These are the various instances of development. But in terms of the technicality, if you ask me, most of the builders or developers have been taking the stand that plotting is a mere sale of land, and it should not. It is covered as part of the 5 Schedule 3, and it is not subjected to any kind of supply or of good or service. So it should not be subjected to a specificality in terms of GST. But when it comes to the partnership or hybrid model, this is one of the avenues where me and Venkat were also discussing. Most of the builders or the developers and the landowners put together, the law has been specifying on TDRs and reversal of unsold inventories as on the date of completion. So better that most of, even in terms of the residential apartments or in terms of the plotting activity, better that most of the landowners and the developers comprise into a partnership firm, and the landowner contributes the land as a capital into the partnership firm, and they take over the revenue sharing agreement as an MOU. So what it does is, so it will avoid most of the TDR or the JDA kind of a discussion, and it will be developed as an own particular development. So that is one area, the tax planning avenue or the litigation avenue where the developer and the landowner can plan about. In terms of revenue sharing projects, most of the amounts which are being distributed between the developer and the landowner are receipts after the sale of the land. The land which is developed land, first of all the argument of the assessees has been land sale is not subjected to GST. Second of all, if there is complete development and there is no vertical structure on the land, then is it going to be considered as mere land or land which is developed, which is amicable for living? Most of the builders, they have been going for infrastructural facilities like plantation, maintenance for 2 years, the corridor building, and also farmlands nowadays have become very famous. So if all this clubbed together are provided as part and parcel of the agreement itself, and the entire consideration on which the documentation is being created is being subjected to a stamp duty, and only land is mentioned and rest of the avenues are going in as part of the entire supply as far as land is concerned, then I think it's going to be only land sale and it should not be comprising of any other aspects. But in terms of specificality, if the compensation or the collections are happening for the maintenance, plantation, and also for the clubhouse and other things that the plotting developers have been doing, on that particular aspect, whether there is a separate agreement for that, whether there is a bifurcation in terms of the sale of land versus the other aspects or amenities being provided or the maintenance charges being provided, is a question of test. So most of the developers or builders should go for a specific and bifurcated agreement if at all they are going for other amenities or charges based on their other amenities. And also in terms of specifically mentioning the plantation activity, there is another argument which has been raised by few builders saying that when they are creating a farmland of 1 acre or a half acre farm plots, in that kind of a scenario, whether there is going to be an argument of agricultural production as well. So even that was a subject matter of discussion. So we have to create documentation in such a way that it is a mere sale consumption and it is not a particular comprising of a service element being involved. Whenever there is a development through a developer, how is it going to impact? So there is a famous Supreme Court ruling which is Hindustan Shipyard, which says that construction of a ship is equal to sale of a ship. So the same particular aspect applies to land also. So if the land development and the benefits emanating from land development or the sale of land as such will not be comprising of any of the GST element. But the argument of the department has been that sale of plot is not equal to sale of land. So this is the exact thing that the Nani Construction Supreme Court has brought about. So based on this particular Supreme Court ruling, there have been X number of judicial precedents which have mentioned that the basic idea of conclusion is that the land specifically or the taxation specifically comes up for the sale of plot. So there is confusion, and wherever the development of plots are happening, we have the specific question for the Commissioner also. Wherever the development of plots is happening, whether it is subjected to GST or not is a subject matter of discussion. Whenever the development is happening through the JDA, on the screen we have summarized the importance and the marked spaces within developers and Sri Dinesh Anil Kumar, PTD Living Spaces, Satya Infratech. These are the AR rulings which have brought about. And in terms of the specificality on the agreement perspective, whether it is going to be a single agreement or a dual agreement of splitting the land sale versus the amenity sale is one thing which we will discuss again. But in case of a famous JDA structure, how is it going to actually impact is the question mark. So in the hands of the landowner versus in the hands of the developer, whether the land sale is going to be treated, the enhanced value of the land sale in the hands of the landowner, which is the cost attributable to the developer share. The land which he has foregone as a landowner plus 10% would be the value at which the department would target to tax the landowner. And in terms of the input tax credit eligibility, to the extent of the development charges, pertaining to the landowner share, they are still eligible to take over that eligibility of ITC. In the hands of the developer, when the actual valuation is happening, the development cost of the land, developer on the entity basis or the entire development cost plus 10% is the target that the department is going for subjecting it to GST. In terms of eligibility, again, on the outward supply, once we say that it's a sale of land and I am not subjected to GST, then you are obviously not eligible for ITC. But on the development charges, to the extent of development cost or the developer itself, there is a chance that we can claim eligibility of ITC itself. So once the department comes back to us stating that GST is applicable on that, then the without prejudice argument will come into the picture saying that ITC component, whether it can be claimed to that extent of development charges or not. So this is a specific summary which we have prepared for the JDA structures. In terms of the entire summarized evaluation on the plotting, contractor, if it is done through a subcontractor kind of activity, most of the subcontractors who are registered above 20 lakhs are subjected to GST and he is required to give invoice to the developer. But in terms of the contractor being subjected to GST, the practical aspect has been most of the developers have been going for various subdivided subcontractors so that the number should come down to 20 lakhs and each category or each segment of the plotting development should be done through the unregistered people to avoid GST. But the aspect is contractor as such, if the value is above 20 lakhs should be subjected to the GST. Developer, to the extent of his infrastructural development charges, he is subjected to GST. Landowner in no case should be subjected to GST. The buyers of the plot who actually do it, if at all the agreement, it all depends on the agreement that they are entering. So this is a summary that we have prepared. For a sale of plot without infrastructure, it is not liable to GST. For a sale of plot with infrastructure, the infrastructure component or the designated development charges will be subjected to the GST. In case it is a single agreement, before completion of it, if the development is not yet started and it is a barren land or just the planning activity is going on, then it is not subjected to GST because it's near land. But after completion of it, the argument here is the test. So once the argument is that it is a completed land without any vertical structure and without any kind of building component coming into picture, 5 Schedule 3 comes into place and we have to take the argument that it is not liable. It is the debatable point here that whether the department is going to target that particular purchase of completed land to be subjected to GST or not. Whenever there are two specific agreements, whenever the split happens on the development charges and infrastructure charges and also on the land as such, then it will be only on the development charges and the amenities and common facilities that are going to come into picture. So the documentation, the plan that landowner and developer would have with each other in the structural days would play a very wide role in escaping the entire ambit or confusion of the GST component. So in terms of tax planning avenues, should we start or?
In this
yeah, please.
Going into an agreement with the customer for selling of this plot. Okay. Suppose we mention immovable plot, not the infrastructure and other benefits. Though we are selling the plot, would that attract GST?
So that's what we said initially, sir. The immovable property without any kind of bifurcation on the amenities or common facilities or the plantation or the amenities that you are giving, then it should not attract GST. But only point is when you have a separate segregated agreement in terms of the development cost or infrastructural facilities that you would be giving or the amenities that you promise them for the next 2 years or 1.5 years, then the actual GST component will come into picture.
So though there is a value addition in terms of value.
So ultimately it's land and you have specifically mentioned that it is immovable property. Venkat, you can add.
Yes. We are not discussed.
And also, we also wanted to cover the commission agents. So we have covered the landowner, developer, subcontractor, and also the sale which happens to the commission agents. So whatever commission agents remuneration that we are actually paying to the commission agents for the sale of the land or the plots, whether it is subjected to GST or not, So in terms of the requirement, the commission agent should actually get registered, and we have to have that this thing. But practical scenarios, no commission agents are actually registered for GST. That is the target area for the department on all the commission payments. So we have also attached a questionnaire which the department has been issuing to the real estate builders as well as to the plotting developers in the handouts that we have given and also in the circulars. So in that particular aspect, the two main things that the department is focusing on is whether there is a development charge specifically that is charged by the builders and developers, whether it is being taken into the books and it is not registered as a stamp duty, point number one. Whether there is a difference between the stamp duty documentation that is being placed and the actual value that is received. Point number three, whether the subcontractors are involved in the entire scope of activity and has a GST invoice raised by the subcontractor to the developer or not. And there are instances where when the audit of the developers is happening, subcontractors have been subjected to the scrutiny again in return because they have not raised GST invoice or they have not sent to the GST perspective. In terms of the commission agents, the fourth point that I wanted to actually cover. So these 5 aspects, 4 or 5 aspects are the important things that the GST audit perspective from a development of plotting and from audit perspective, departmental audit perspective is concerned. So any other doubts on plotting, we'll be very happy to take it. Yeah.
Like you said, there is a difference between stamp duty value and actual values. What happening is the developer itself. Developer is nothing but they are taking the selling of the plot. But what they are doing is their layout approval they are taking on the landowner itself. Later they are taking an agreement saying that I am going to sell your plots, and they are using commission agents. Now while receiving the payment for the registration value is 1,000 rupees, whereas they have collected. Collected means whoever is selling, the person is collecting around 5,000 rupees. The difference of 4,000 rupees, they are saying that since you are not shown anywhere, even though you have given a white receipt to the customer, you have given a 4,000 rupees plus 1,000 rupees registration value. For 1,000 rupees you have a sale deed. For 4,000 you have a receipt for the customer. But registration value is only 1,000. Even though you have given 4,000 as a sale of land on the on the receipt you are mentioning that sale of land. But since you are not mentioned in the sale deed, I am taking this entire 4,000 as a service component.
No, that cannot be told, because as long as that whether I pay stamp duty on the less value, high value, the sold of the transaction remains as sale of land. So what I have sold finally is sale of land. At best, department can ask only on the development cost. Beyond development cost, they can't ask on the even I reduce it. If at all there is a violation, there is a violation of stamp duty, because as per the stamp duty also I should actually register for the actual sale value. If there is a violation of not paying stamp duty on the 4,000 component, stamp duty is for the stamp duty department to come and ask, not for the GST to say that I am giving 4,000 as the development charges. Hope I am clear.
See, I'll put it simply. I understood your point. See, the point is the differential component between the books, whatever receipt that they have taken, versus the stamp duty will be the target of the department. So that will be the specific charge that they will be targeting during the assessment proceedings. So we have to avoid that confusion and say that at least it has to be in the pretext of all the builders and also the developers, saying that there should not be any difference versus books receipt and the stamp duty collection. So whatever we have to do, it has to be on the single number. I'll also extend this topic. So what will happen if I pay it on the full value? I'm only going to lose out 6% stamp duty. But if you do not do that, the entire value, differential value, will be subjected as development charge or this thing, and 18% will come into picture. And also interest penalty and other stuff will come into picture. So what is better, paying the entire stamp duty document at 6% and getting it through?
Yeah, but
Only one nation.
because
Only one nation. When you are prepared for paying GST or not prepared for paying GST or going for a full value for registration, you ensure that whatever the input what you are losing on the development cost. Suppose you would have engaged contractor to do this plotting, or you would have bought some machineries. All that, if you evaluate how much ITC you are losing because of development cost by not paying GST and taking a position that total value is land and I am not paying any GST on the development. That factor also we should consider. Otherwise, go ahead.
So even in the case of joint development agreement with landowners, still this removable
Can be
treated
can be told.
during the progress of the work, before completion or before getting the final.
In fact, there is important aspect is that whatever the amenities I develop in the plotting, finally customer is not, though he may actually enjoy, but this ownership goes to the municipality or the regulatory authority. It will not be given to the customer. That is another important point. Unlike apartment association, the amenities or the infrastructure developed will be given to the association. That means the flat owner becomes the owner. Whereas in plotting, that is not the case. The entire infrastructure has to be given as gift deed to the municipality authorities or the local authorities. That is another important point to say that whatever the development I have given it to the municipality, not to the customer. So why then customer is enjoying that government is giving. How public roads are given by the government, the same way the plotting within infrastructure government is giving. So that is another important critical factor which you should consider by saying that there is a development service.
For tax planning, should we show, says development cost as separate value?
Better to avoid this dispute.
So we have covered that in the tax planning, questions. So you can actually have segmentation of the development charge by yourself to avoid all this discussion, and have at least 10%, 15% value of the entire thing and segregate it and charge GST on that. So that the entire thing which the department is trying to do, you are actually bifurcating it and giving it, and you can argue that I have already disclosed it voluntarily. So that is slightly getting injected into the developer community right now. So it's not like earlier days where they do not want to pay anything. So they have come to a certain conclusion saying that 15-20% of the entire thing we will push it towards the development charge and pay GST on that, and rest of it they'll offer as sale of land. So that's one area where we are trying to cover.
In case JDA,
Yes.
60-40 sharing.
Yes.
See, 40% land you will give to the developer, the landowner. 60% land landowner will take. So how to determine the consideration? That 40% is liable for GST to the landowner. The developer has right in mind.
Are you asking TDR in the context of no? Are you asking that how suppose
developer.
So to put it otherwise, 40% of the land component which I got as a plotted development, I sell it to my customers as a developer, and going by the whatever theory what we discussed, we'll have some portion towards development charges and pay GST on it and take the credit. So this is the development share. So are you asking what is the treatment should be given to 60% given to the landowner? Are you asking that?
Yeah, the 40% he has given a consideration for development charges.
Yes.
This 40% is liable for GST.
No.
Like he has given 40% land for development of the flat.
No. What he is getting finally he is getting same land, no?
He is giving the land.
So what we'll do, sir, immediately as far as JDA is concerned, please reserve your question. There is a separate slides covering all scenarios. We'll try to cover all possibilities. Please hold for some time. Once these planning aspects are done, we'll get into the JDAs.
So this is a summary of all the judgments that I was just talking about in terms of the AR rulings which the department is contesting. So most of the argument is around the composite supply of land versus the amenities and the extra things that the department has been, subjecting it to. So our argument is it's a mere sale of land, but the department has been focusing on the composite supply of land and other amenities put together. So we have to bifurcate and provide the documentation and plan it in such a way that we are ready with the answers, and like how we just discussed, it has to be specifically put across in such a way that development charges are bifurcated and offered to tax specifically to avoid all the confusions from the beginning itself. So on the time of supply and place of supply, let's spend 1 minute. So when the time of supply is coming to picture, the immediate payment requirement will jump into, if the payments are being made in installments, how is it going to be covered? So we just summarized that. So a lot of questions came on installment payments of the plots. how will it have to be offered to GST. So in terms of the first installment, second installment and third installment, the immediate 28th of the next month, you have to offer that to tax. So you cannot keep it till the year end or till the completion of the project. This is one part that we wanted to clarify. And also in terms of place of supply, when the location of the supplier itself and the developer, both in landowner and developer are pertaining to the same state, then we have to offer CGST, SGST. If at all the developer is doing the immovable property development in different states and he should actually get into IGST. But we have portrayed various scenarios where in the location of the supplier, recipient and the location of the immovable property, if it is in different scenarios, how is it going to be? So mostly it is going to be the location of the immovable property where we have to subject it to the GST. So we will get on to the tax planning revenues. So when it will start. So mostly there are almost around 15 topics which we try to cover in the real estate sector on the tax planning revenues. So and also a few questions which we have had, or few questions which were posed at us when we announced the session. So returnable security deposit. This is one area where most of the developers and the builders have been doing in terms of taking it as an abnormal amount. This versus the goodwill component which comes into aspect in commercial development also, whether it can be reasonable or unreasonable, and what is the definition of reasonable or unreasonable. Go ahead.
See, as you all know, so the receipt of deposits, any amount you take it as a deposit is not liable for GST unless you adjust for any advance or any particular supply transaction. That is the general position of GST on the deposits. So taking this advantage of this deposit not being subject to GST, there are some practices evolved across the country where what they'll do. Suppose take example of rental. So there is a per month rent is 1 lakh. So if I take 1 lakh as a rent and pay, then I have to end up paying GST at 18%. So what they do, and any rental agreement will have some clause for the returnable deposit or refundable deposit. So what they are making a clause that they are putting the abnormal deposit, saying that generally there is a 6 months or 3 months rent deposit as a returnable deposit. What they do is they put such a way that the rental become nominal value. That means that will come to 10,000, and 90,000 will be compensated by the interest value of the deposit. That means normal you are eligible for the 6 months interest. That means 6 lakhs as a deposit. They make 1 crore as a deposit. So that means whatever the interest on that 1 crore, you keep getting, but you get it compensated by the rent. So thereby you are showing 10,000 as a rent and you are paying only GST 18%. And because that 1 crore you are getting interest, neither interest is not liable for GST nor anyway deposit is not subject, 1 crore is not subject to GST. This can be taken, this can be planned, but this abnormal situation is highly questionable, and it is wrong for the department to say that neighbor properties they are paying 1 lakh rent and you are taking only 10,000. This 90,000 is not at all acceptable, and there is a problem with income tax also. So that's the reason when this can be planned, but you plan such a way that you at least to strike a balance between this normality and abnormality. So don't get into abnormal planning and get excited saying that I'm getting waiver of 18% of 90,000 and market everywhere and say that don't pay GST of 90,000. So that is one point we would like to highlight.
This is a live case. Actually, this happened with one of the developer or the builder where he has taken security deposit for almost around 1 year. So the entire value went mismatched and there is a lot of confusion, and they have actually gone for a similar property, akin property or a like property in the neighborhood, and when they have verified the documentation in the department, it was only 3 months or 2 months. So the valuation will go for a toss, and they have been very, very vigilant about all these things nowadays. So this is one area where we wanted to talk. We wanted to talk about goodwill as well. So goodwill on commercial properties. Yeah.
This.
We have Hcas here, so please sir, please come onto the dais. So he's almost around, please sir, please come, please. It's okay.
Yeah, after completion of
Okay.
So, as far as this goodwill as well as return, see generally this, to elaborate this transaction, see what this is concept that people they say today, tomorrow they come to, today they'll come to builder and say, today I give 1 crore to you, after 3 years or 5 years you give me 2 crores. So that is the model. So that means it's nothing but investment and taking the money. So now the question is how this, suppose after 3 years the builder has repaid me 2 crores. Now the question is, should I pay GST at the time of receiving 1 crore and pay GST on 1 crore, and when returning the 2 crores, how should I manage this? So to answer this, if you are showing this investment of 1 crore towards any particular unit, that means flat or villa or any land, of course land is not liable for GST. If you are attributing and allocating any unit, either flat or villa, you have to pay GST on that 1 crore whenever you get the money. If you are showing it as an unsecured loan or another business loan or kind of it, then you can say that this is not an advance, this is not for any sale or anything, it is nothing but the nature of loan. So it is not subject to GST, and when while returning also, anyway that is nothing but return of money and return of investment. So there is no question of GST either in the hands of builder or in the hands of the person who is investing.
When you're talking about refundable advance or goodwill?
Goodwill.
Goodwill.
So goodwill is nothing but 1 crore. No?
Goodwill you pay, it will not come back to you.
No, I am talking about from the perspective of the investor. Suppose I put 1 crore, I'll come and give you 1 crore and say 3 years, after 3 years you give me 2 crores, I'll exit from the project. So that background I'm talking.
That is a famous clause that they're planning. So that particular clause will happen after 3 years
This
of
will happen,
development.
I think you must be better aware. So wherever builders have a tight position of getting loans or debts and all, they'll go to people who have money and they'll ask for this kind of make arrangements. Like in that background we are making this one.
In the revenue sharing model,
JDA will separate.
so the sale of plots also we have covered in terms of development charges and common facility services. Contribution of corpus to transfer of RWA is also covered. Booking cancellation charges and transfer charges is also covered.
That is covered.
Valuation?
TDR and other will take separately then. One second, go back. Valuation. Yeah. Another very interesting and highly disputable point is this land deduction. So if you recollect my beginning of the section, I told there are 3 components in the real estate transaction. Material, labor and land. Material and labor anyway liable for GST, land is not liable for GST. So that's the reason you find that their government also coming and saying 1/3 I am treating as a towards the land and they are giving deduction, and in effect you are paying 2/3 of your sale value. So now the question is it 1/3 is across uniform over the country? Suppose if I sell a flat in Banjara Hills, if per square feet may be 10,000 per square feet, and the land component would be 80% or 90% also for that matter, because how luxury you construct, how premium you construct, your land construction cost will not go beyond 2,000 or 2,500. I think many people are there, they can confirm. The construction cost may not go beyond 2,000 or 2,500, maximum 3,000 you can go. Even if you give furnished also, it will not go to 4,000. So that means that if you see the land component in these premium projects or the premium areas or luxurious projects, the land component or land value is more than 1/3. In fact, it goes to almost 70% or 60% or some cases 80% also. In case of Mumbai, in fact it is 90%. Then in this background, is it fair to say that I go government, on the part of government, to say that only 1/3 I will give a deduction and balance you have to pay GST? That is his main question. So to answer to this, if you look at the theory of this DMO deduction, if you look at any VAT or service tax, when they are making this kind of deduction, they say first you arrive the actual value. If you are not able to ascertain that actual value, then you go for the DMO deduction. That is how they used to do. Even in VAT also there are deductions, standard deductions concept. In service tax also there is composite rate. That means they are also first they are giving the option for arriving actual value, then composition. But in GST that was not done. Everything is shortcut. They says 1/3 is land value, you deduct and pay 2/3 on the GST. So thereby this is not a correct and legal provision where it says across India and across all projects 1/3 is only the land deduction. You are not eligible beyond that. That is not a correct provision. In fact, we are in the process of challenging our own Telangana High Court. So there is high chance that we get case in our favor. So to sum and substance of the discussion is that wherever the projects, the land component is more than 1/3 and it is substantially higher than the 1/3, it is advisable and go for an actual value. There is one more reason of going for actual value also. State government who are also party to the GST and they are also collecting a GST portion. They themselves coming and for stamp duty value, they are coming saying that this is the land value in Banjara Hills. While coming, which may be 60% or 70% of the land component, whereas coming to GST they say only 1/3. So there is a contradiction between the same government. So thereby it is very arguable and very interesting to say that wherever projects where you have more than 1/3 land deduction, you definitely should try and say take actual value, take the documentation, either SRO value or put it in your customer agreement that this is the land value and this is the construction value, and that value take the reduction and pay GST only on that. Suppose your land component is 50%, then instead of taking only 1/3, you take 50% reduction. That is very, that saves a lot of GST. Hope I am clear.
When there is a separation, then again 18% charge will come.
No suppression, no. See, the suppression, there will not be suppression. What are the notification says? What are the notification says? Total amount you pay 7.5%. They are not coming straight forward and saying that 5% is waste. They say 7.5% is the rate, and in the value they say 1/3 I treat it as a land deduction. So if you say this is not 1/3, it is more than that. So you pay 7.5 only, that 50% only, that means 3.75. That is technically can be told. There is no problem.
So, instead of blindly going by 5% or 1%, whatever the builders, they can actually go by this particular aspect and go for 7.5 and claim a lot of deduction on the value of land. That's what he's trying to say. So, ought to pay GST on construction services incurred only after booking of flat. So please.
Sir, please come on stage.
Please come. Yeah, it's already started. Please.
Session is still due, sir. So it will take some more time, but please come.
Please.
No, please come. So, Ambaran sir, he is the Commissioner of Secretariat of GST Commissioner as well as Sangareddy. So I request to take contact.
Ought to pay GST on construction services incurred only after booking of flat. So whether the completion certificate is the criteria, architects is the criteria is already covered. But in terms of payment of GST on construction services as such, what is the loop point and where the department is actually targeting to do it and where we can save?
So here the point is there is as I was discussing the self-service concept. The self-service concept is that till I enter contract with the customer, I am become the owner, I continue to be the owner of the flat. So in that background there is argument that there is self-service to me, whatever the construction I did, it is self-service. So in that background, in fact this was discussed by Supreme Court in L&T, which was quoted in the previous slides, where it says until customer comes and enters agreement, there is no host contract, there is no contract, so you can say that it is self-service. But once customer enters any agreement, be it agreement of sale or booking form or any work order, that is sufficient to say that there is a contract of construction and you have to pay whatever the VAT or sales service tax on that. That is the judgment of Supreme Court. So taking cue from that judgment, we can say wherever the people are not selling the flats immediately or flats sold after some point of time, that means after 2-3 years of the construction. So we can say only the portion of the construction started after the booking of the flat. That is only liable for GST, not the total value of the flat. That can be told.
So in terms of construction, consideration of exemptions, pure labor or material component, pure labor, as everybody know, for the single houses and the planning around it, pure labor is completely exempt. But in terms of the material contracts, if the value of the material in the pure labor arrangement is less than 25, then whether there is a probability of separate contract and splitting the contracts as such will be beneficial, or the pure labor segment as such, if it is material component more than 25%, what would happen?
Yeah. So he's in the background of there is a exemption entry where they says any residential unit, that is single residential unit, if it is constructed and the contract is only for the pure labor service. Suppose you have a land and you engage some contractor, he only comes and construct and goes off. Whatever the material required for the construction, if the owner is providing, that is exempted from GST. This was there from service tax also. In GST they said only pure labor contracts, but later it was extended to say that not only pure 100% labor contract, even up to 25% of material is there, it is still get exemption. Please note, it is only for the single residential units, not for the gated community projects. So if any apartment, be it 2 floors or 4 floors, if any apartment is there, this exemption is not relevant. It is only for the individual houses construction. There are some projects taken by the builders where they say they will sell the land first. Wherever the customers want, so and so plot, customer wants to construct a building, the same builder, the person who sold the land will construct and give. In those background I am talking about, if that in that background, if you are take a contract only for the labor work and procure all material in the name of customer, then we can take that exemption, we can get away from the GST liability. That planning is possible, subject to you not losing the input more than what you pay GST and output.
Under the new scheme, most of the builders are planning around the composition dealers. I mean, whoever they deal for the purpose of registered supply of 80%. What is the criteria if I deal with composite supplier? Is it going to save from the dealer's perspective? This is planning within the 4 walls of law. But what happens generally from a composition dealer standpoint is he's charging you only at 6%, whereas compared to a full-fledged registered dealer. So how much extent can we go for the composite dealers? How much extent we can go for the registered dealers?
Yeah, so this is in the background that there is 80% condition where you have to procure from registered taxable persons. If you don't procure, you end up paying labor charge at the rate of 80%. So there in that background, instead of you not taking GST from the registered person on the GST, if you procure from unregistered, you end up paying 80% GST and labor charge, which will become a cost to the company. So instead of that, what you can do is wherever your supplier's turnover exceeds 20 lakhs, then you can advise them to at least, if they are not at least not charging, advise them to at least go for a compound scheme and charge 6%. So in a way you can save the 12% to that extent. So this is permissible. Even government also gives given notification saying that if your turnover in any financial year do not exceed 50 lakhs, you are as a service provider, you can charge 6% compound rate. So straight away you will save 12%. So that is one more possibility is there.
Under the new scheme, the restricted purchases to the extent of purchases from the GST suppliers only for cement can be planned, or can it be mixed and matched for the 28% on cement?
So as I was saying, the cement there is no 20% relaxation. Everything you have to procure from registered persons. So especially when you are procuring any cement, you ensure that you procure from registered taxable persons. So otherwise you end up paying GST. So there is no point in you paying more than what is required.
All the capital intensive equipments like dumpers, tippers, excavators, whether it is cost effective for the developers to go for hiring instead of purchase on the component, even on the input component of the capital products, how it can be planned?
So here this is in the background that if you procure any dumpers and excavators, you become a capital goods. So if you procure from registered person, fine, they charge GST and it will become cost anyway. But if you don't procure from registered person, you end up paying GST at under reverse charge at the applicable rate. Instead of that, if you go for service, that is leasing, so that person anyway that is not a capital good, that is only service. So you end up paying only 18%. That is the background.
And the parallel registration activity in terms of the landowner versus the builder with effect from the notification of 2/2021, can can the parallel registration and the documentation avoid any kind of loops that the developer and LO would create in terms of ITC? Because the 2002-2021 says developer who can pay the liability at any given point of time on or before the completion certificate, and landowner also can claim the ITC parallelly to that particular extent. So parallel registration and invoicing, how can it be planned?
Yeah. So this is here, suppose if you see the condition of the 5%, one of the conditions that you should pay GST on the landowner share at 5%, and the landowner in turn has to pay GST whenever he sells to his customer. That is the scheme. Here, prior to this latest amendment, the position was going with notification. They says is developer paying GST on the landowner share will be postponed to the completion certificate date. That means he will pay GST on the area given to landowner only at the time of completion of the project. So till that time you don't pay GST. So if you don't pay GST, landowner is not going to get any input tax credit till that, because he don't give invoice till that time. Suppose landowner sells in between before the completion. So once he sells before the completion, he has to pay GST, because once 20 lakh exceeds, you are selling before completion certificate, you have to pay GST. Now the question comes is, I don't get any input, I have to collect 5% and pay in cash. Suppose landowner has no any other project, at the completion certificate date, all of a sudden the developer will come and give invoice for total flats. Out of that, 30 flats would have been sold before the completion certificate, you have paid in cash. So now all of a sudden that huge ITC has come and sitting, then what to do with that? So that is the glitch is there in the notification originally. So to avoid, to fix that glitch, what government also has come with the latest notification, where they are told, you do not wait till the completion certificate, you can give invoice at any point of time at your convenience, but the last cutoff date would be the completion certificate. This is to enable the developer to give invoice today, so that suppose there is 40 flats are given to the landowner share, 40 flats each GST liability, suppose it is 1 crore, 40 crores GST input, it can be passed on to the landowner today, landowner will take the credit and utilize for his sales in turn, so that landowner don't end up paying GST in cash, and also optimize the utilization of the ITC. That is the overall impact of the new notification. One point is that because it is nothing but a cumulative amendment, we can say it is applicable for the retrospective, and only for the first April 2018 also this can be taken as advantage.
In terms of the maintenance charges, Resident Welfare Association maintenance charges, the basic exemption criteria specified by the circular is 7,500 rupees per member per month. So when the excess amount is collected, say suppose in big gated communities, even if it is around 9,000, 10,000, how much is to be considered for the GST charge, whether it is the net amount or the total amount of 9,000, 10,000?
Yeah. So here there is an exemption for the association. If monthly maintenance charges are not exceeding 7,500, there is exemption. The exemption it says it is exempted up to 7,500 per month. Their interpretation is the usage of the word up to 7,500. Does it indicate that whether you collect excess of 7,500 or less than 7,500, up to 7,500 you are eligible for exemption or not? Suppose take example of 7,000 you are collecting. So because it is not exceeding 7,500, you are not liable for exemption GST, and it is exempted. So that is one theory. The second theory is that suppose you are collecting 9,000 per member per month. Now the question comes is, because the amount exceeding 7,500, here should I pay GST on the entire 9,000 because it is exceeding the 7,500, or only in excess of the 7,500? So that is only the 1,500. This is the interpretation that is coming. So because this is coming because notification doesn't say that exemption is available if the amount is collected is only less than 7,500. It says up to 7,500. General meaning of English meaning of the up to is that is cut-off amount. So up to you get it. So this is the point was taken by recently by Madras High Court also, Greenwood Estate Owners Association. I think it was not marked here. So they are told usage of the up to indicates that if you collect 9,000, only the in excess of the 7,500 only is subject to GST, and GST is liable only on the 1,500, not on the 9,000. This is the interpretation of upheld by Madras High Court. While taking this stand, please remember that you are also have to sacrifice the input cost on the various charges incurred by the association. So you end up reversing that to an extent of 7,500. Please bear that in mind while making this interpretation.
In terms of the supply of electricity, water and gas
We have
facilities,
covered- we covered
it's done, your agent concept. Cancellation of flats also is covered, I believe. So, cancellation of flats, the time limit of the credit note being elapsed and the refund claim on that particular aspect
That
was
was
covered.
covered.
And the maintenance and clubhouse membership charges collected before and after the completion, the post-construction, and if it is collected in advance by the builders for the first 2 years, which is a regular practice, 18% versus 5%. If it is collected before, it can be clubbed under 5% is the position. Compensation from government or land disputes is not taxable. That's all. I think we've covered most of the questions. So any other points from the members? So we can just take a 5 minutes break and go for the panel discussion.
So after the break, we'll have panel discussion, Commissioner sir and Hcas sir, and followed by the JDA slides on the JD also we'll discuss.